Trade alert, collect another $720 today. That's a total of $3,590 just this week. New trade alert at the end of this video. Recap, we collected $1,868 on Monday, $636 on Tuesday, $366 on Wednesday, and today we're bringing in an extra $720 from our China and India positions. That's a total of $3,590 of income we've collected this week from a model portfolio of $250,000, which has its total assets targeting a 70% stock position, a 10% cash position, a 10% gold position, and a 10% digital money position. Currently, we are heavy on stocks, cash, and gold, and light in digital money. I'm waiting a few weeks to see if we can't get that digital money position rebalanced at a discount. The stocks are diversified into a basket of country ETF indexes. The cash is for a rainy day or when volatility is low and we're not selling options. The gold position is for surefire inflation protection, and the digital money is for aggressive inflation protection, plus the potential for continued exponential growth. Here's our portfolio summary as of this morning prior to placing today's new trades. As you can see, we originally released the platform with only the cryptocurrency module, and cryptocurrencies have been losing value in 2018. However, that was only intended to be part of a total portfolio strategy. This week, we've finished completing the stock and option portion of the portfolio, which also holds our gold and cash allocations. And we've been able to start quickly re-earning those losses so that we can add to our digital money portfolio. While the model portfolio has lost $8,000 in digital money value over the past 3 months, only after a week of adding the stocks and options module, we've already made back half of those losses. Your personal portfolio builder income module will be released very soon. This week, my goal is to illustrate how powerful the add-on is and get you ready to start using it. I'm making no changes to my digital money portfolio as my target positions, despite having lost significant value in 2018, are still very close to their target percentage per position. And we're using the 30-day trading volume of each coin relative to its peers to decide what percentage of our portfolio should own each digital money. Our stock portfolio, on the other hand, has 2 new opportunities to make money today. 2 of our option contracts we wrote this Monday were assigned yesterday, which means it's prudent to reload those positions today and keep the profits rolling in. If you've ever heard the saying, make hay while the sun's shining, for our strategy, volatility is the sun, and the sun's shining bright whenever the VIX is above 15. Right now it's trading at 21, and the last time we saw volatility this high was back in February of 2017. Now, after volatility has dropped back down to the $10 to $15 range, expect to see my model portfolio simply hold onto its equity shares and buy out of the money put options while option premium is cheap. I'm planning for this portfolio to survive the next financial crisis, and it will have to give up part of the weekly profits to buy crash insurance the next time option premium is cheap. Here's that picture of the SPY, and it's everyone's big question is, when will the next financial crisis strike, and what will it look like? In 2000, the crash lasted 2 years. In 2008, only 1. Here's my open option writing position manager tab so that you can see the 2 positions that were assigned yesterday on MCHI and INDA, China and India. We can see MCHI and INDA, the strike price is now less than the ETF's current price. In fact, it's less than that plus the difference of the premium paid to sell that option contract. So what's happened is the person who bought that call option is able to exercise their right and generate a profit. When you write a covered call, which is where you sell one call option contract per 100 shares of the underlying stock you own, when the strike price plus the option start price become greater than the ETF's current price, you're very likely to be assigned. In this case, on the Chinese ETF MCHI, we had 8 contracts or 800 shares assigned at the strike price of $55. Plus, we get to keep the initial 85-cent share premium we collected, selling the option buyer the rights to our shares. Here was the original trade we placed this Monday. Sell to open 8 December 21st, 2018, MCHI, $55 strike call option. We used a limit order because there's a wide spread on the bid and ask, and place that limit slightly below the mid. When we wrote this contract, MCHI was trading at 54.14. So we were able to make a profit of 85 cents a share, the premium collected, plus the difference in the strike price and the current price, which is $55 strike minus the 54.14 price when writing the contract, or an additional 86 cents of profit per share. That's $1.71 profit per share times 800 shares, or $1,368 profit in 72 hours against $44,000 worth of our capital at work. A 3.1% return in 3 trading days. If you were very lucky and made a 3.1% return every week starting with $44,000 and reinvested the profits for 52 weeks, it would turn into a staggering $215,000 in a year. Now that's just to give you an idea of how powerful compounding small profits can be in the long term. Here's the trade alert from Monday on the ETF INDA, which is the India ETF. Sell to open 3 December 21st, 2018, $31 strike call options. We used a limit order of 30 cents, and if that wasn't filled, you would probably need to drop it by a penny or two right below the mid price. We picked up 30 cents of premium from writing the option contract, plus a profit of 86 cents when you look at the INDA trading price of $30.14 versus the option strike price of $31. On 300 shares with a profit of $1.16 a share, that's a total of $348, or an ROI of 3.7% in just 3 trading days. I'll spare you the compounding calculator's potential returns, but hopefully by now you're starting to see the power of doing this over and over again. Let's look at the work I needed to do in the Portfolio Builder platform in order to facilitate my next set of trades. And remember, your add-on module is almost ready for delivery. Here's my work today. First, I need to move those 2 positions from open to closed. And so now you can see up top in this area, those trades are gone and they've been simply moved down below to the closed option writing. And this image was split in half, but it's really just one long row. And we can see the closed ROI. Up top, we're demonstrating what the return on investment is compared to the strike price times 100 times the amount of contracts. But down below, we're just looking at the profit on the premium collected versus any premium we had to pay to potentially buy the position back. In our case, we're not actually ever buying our positions back. We either want to be assigned or let them expire and just keep the full premium. So you can see we've now moved these trades below and are now set up to get back into our positions. So now I need to reference that I was assigned, which means I had to sell my shares of MCHI and INDA at the agreed strikes. And now our top portion of our portfolio builder will automatically reflect that we have too much cash from selling our stock and need to buy back 759 shares of MCHI and 273 shares of INDA to get back to the target allocation per country. So you can see we now have $54,000 more than we're supposed to, and we are short China and India shares by 759 and 273. So if we sell 8 put option contracts of China and 3 of India, we will go slightly above the amount required. But that's what we'll need to be able to get the maximum option premium from these 2 countries while volatility is still high at current levels of 21. So here's again the Money Manager tool telling us in general which portion of our portfolio is over or underweight. And right now we're underweight on stocks, overweight on cash, overweight on gold, and underweight on digital money. Okay, so now we're ready to collect $720 buying back into the China and India. Here's the trades. Trade alert 1, sell to open 8 contracts of the December 21, 2018 $56 strike MCHI put option with a limit order of 90 cents, which is 5 cents below the mid for an easy fill, which will bring us 90 cents a share of option premium times 100 shares per contract times 8 contracts, or $720. And here's how it is filled out at the Tradier brokerage, but it would be filled out exactly the same at your preferred broker. I do like Tradier and Interactive Brokers for low commission rates. This gives our portfolio a 1.6% return in the next 8 days on the option premium collected versus the $44,800 of capital now held to maintain this position. And that's because we're now on the hook to buy those shares at the agreed strike if the purchaser of our put option exercises the right. So if MCHI dips below $56 strike minus the 90 cents premium share to below $55.10 a share, we'll most likely be assigned and forced to purchase 800 shares of MCHI for $56 a share. Now be warned, this will be higher than the market price when this is executed and would show losses until MCHI has gone back up in value to above 51.10. And here's a look at the MCHI ETF over the past 4 years. This strategy is okay with taking a short-term loss to pick up exposure to MCHI because we intend to hold that position for decades to come. So we're happy to collect the premium and potentially purchase a stock with this trade even if it's at a loss. Now if MCHI does not drop below 55.10, probably within the next few trading days, we'll most likely get to keep the option premium and never be assigned the shares, in which case we'll re-enter the trade as soon as this contract expires. Trade alert number 2, sell to open 3 contracts of the December 21st, 2018 $32 strike on the ETF INDA, the India Country Index Fund, with a limit order of 35 cents, which is 5 cents below the mid for an easier fill, bringing in 30 cents share of option premium times 100 shares per contract times 3 contracts for $90. And excuse me, this is 30 cents and not 35. And here's the trade ticket at Tradier. Sell to open 3, December 21st, 2018, $32 strike. There's a big spread, so we're bidding below the mid price. Now, if there's a tight spread, I'll use a market order. And by a tight spread, at most 3 cents in differential between the bid and ask. This gives our portfolio a 0.9% return in 8 days on the option premium collected versus the $9,600 of capital now held to maintain this position. If INDA dips below $32, our strike price, minus an additional 30 cents, which was paid for the premium to purchase this put option, and goes below $31.70 a share, will most likely be assigned and forced to purchase 300 shares of INDA for $32 a share, which will be higher than the market price when this is executed, and show losses until INDA has gone back up in value. Here's the 4-year chart of INDA. And again, we're not so concerned about short-term price valuations on any given ETF. Our bigger concern is to have diversity in the corporations we're investing in and to remove political risks by investing throughout the top corporations of the 7 highest GDP countries with ETFs and option markets available to us. And so our expectation is to be in and out of INDA for the rest of our lifetime, as their economy is growing rapidly and currently represents about 4% of the world's GDP. And again, if INDA does not drop below $31.70 within the next few trading days, most likely we'll get to keep the option premium and never be assigned shares, in which case we'll re-enter the trade as soon as this contract expires. Here's how I've entered these 2 trades into Portfolio Builder to help monitor the situation daily without having to open my brokerage account. And again, the image is split in half to make it easier to view on the video. So if we look over here, we can see the MCHI and INDA are filled in. The dark pink are the only cells we fill in. So I put in the date entered, the date expiring, the strike price, and the option price start is what we collected. And on the second half of the sheet, we put in the contracts, 8 and 3. In this case, it's a put option we're writing, not a call option, because we're trying to get filled into the stock. It's a short because we're writing. The credit's automatically calculated. Anything that's a light color you don't fill in. And the contract name we paste in, and it will give us a live feed of the price, which again isn't really a concern to us because we're not trying to cover these or micromanage them. We either let them expire or get assigned. Now, I know this is a long video and the trade alert's buried at the bottom, so after we've officially released this new platform add-on, expect an instant trade alert with just the contract and basic trade details sent prior to the full explanatory update, which you're currently watching. So thanks for your time, and look for my next update tomorrow morning.